Just a couple more questions. Obviously, none of us are health experts. We don't know the extent of all this with COVID-19, but a couple data points stick out, and would love to hear your thoughts. You see that these rates are at generational lows, right? Inflation's at generational lows for the most part, at least right now. But the 10-year, I haven't looked today, but I think it was like 0.6, 0.62. Not as low as, but pretty low. But you saw earlier this week, NASDAQ and other markets hitting all-time highs or hovering near all-time highs. What does that mean to you? I'm just curious. I know I don't hold you responsible for any forecasts or the equity markets, but just seeing that dispersion of data points, just what's in front of us. What does that mean to you?
It's shocking to me. I can't really beat around the bush on that. When I look at rates, I believe that most of the time treasuries are arguably the most efficiently priced market in the globe of any asset class, extremely efficient. And so the treasury market, when it's telling you something and it's really glaring, there's something there, right? And it's not to say that one is right and one is wrong. I just, one is flashing red warning signs and the other one is flashing green buy, right? And so there seems to be a little off, and they are interconnected, right? So very, very low rates in bonds means that growth and the ability to grow is even more valued. Because again, if you can get 50 basis points in a 10-year treasury, then if you can get 4% growth in a stock, well, you're getting a lot more, right? Essentially, not to say there's not obviously risk, but so for me, it's been pretty shocking. I think for most people, it's been shocking. But then there's all these other factors that are in play, which is, essentially with the amount of stimulus that's taken place and the Fed intervention, there is an overwhelming player in the market, in the bond markets, that is not economically driven, right? They are policy driven, and so that's having a huge, massive influence in rates markets as well. So, it's a fascinating time. I would say I would say the most interesting part too is that the Fed, as they move, it has all these ancillary effects that they know, and they're actually trying to push, right? So they want corporate credit spreads to be lower. They bought corporate bonds for the first time, which again is a fascinating dynamic if you think about it. If I told you the Fed was going to buy corporate bonds 20 years ago, you'd be shocked, right? They're a half a step away from buying equities, that we're saying, right? I don't know if I believe that, but again, right? I mean, they just keep intervening in more and more markets, and they're a non-economic player, and they have unlimited dollars to spend. So what does that really mean? And so it takes some thinking basically about how that's going to play out. But the one thing I would say is that during these periods when credit spreads are tightening, muni spreads are tightening significantly, because yields are so low, if you just get a little additional spread, well, you're a lot better off, right? It becomes a really treacherous period for bond investors, where the inclination to reach and reach and reach becomes extremely attractive, and you can justify almost any investment at this point. And it's these periods right here where it gets really treacherous, because what's going on in markets is not necessarily what's happening in the real world, right? And credit has significantly declined. The underlying credit quality as a whole, as I would say, has significantly declined. There's not many credits that are in a better position than they were before. And so, everyone's going to feel some pain. They're going to feel it to varying degrees. But the market might tell you that, again, this credit's fine because it's only 15 basis points spread off the AAA scale in munis, when the reality is they have really serious budget issues. And if this is still around in a year, they're going to be facing a cash shortage, right? I mean, the other thing that's happened too is it's happened so fast that rating agencies haven't caught up. So, I mean, I've never seen more AA, single A bonds that may not be around in a year in my whole career, because it's just happened so fast, right? You have a convention center that was doing fantastic. It was backed by tourism tax that was 4 times debt service coverage, was rated AA. Well, they brought in zero revenues, right? And they don't carry a ton of liquidity because they always had 4 times the amount of liquidity they ever needed, right? So they didn't put a bunch aside. And all of a sudden, right, no one saw this coming. And so there's situation. I would say, again, like you preface, a lot of what we do is try to find upside, alpha, things that are going to outperform. But a huge portion of our job is just avoiding landmines, you know, and avoiding things that are going to blow up. And that's become a bigger and bigger portion, I'd say, recently what we did. We named our fund the Siegel Bryan Hamel Municipal Opportunities Fund, and I caught a lot of grief for that. But I named it that for a reason, and I named it that because I view these massive opportunities in the muni market to the upside, but I also view the ability, if you have a wide parameter structure where you can shorten duration or lengthen duration pretty considerably, you can go way up in credit quality or down in credit quality going on in markets. That ability is not only to go down in credit quality to add additional yield, it's also the ability to go way up, right? So we massively outperformed in March. You know, most of our outperformance for this year was just raising a lot of cash and getting short duration. And then the second leg of it was being able to deploy that cash into a very, very weak market and get very long duration, right? And so the opportunity isn't just getting long and low in credit quality, it's also getting up in quality and short in duration. So, you know, my view when we were getting very long in March in duration and credit was that I probably am not going to need to do a whole lot in this portfolio for the next 3 years, right? We're set up. We own awesome bonds. I love what we own. We're in a great spot. And I figured the market would kind of drift around and maybe 2 or 3 years from now, things would kind of get fairly valued, maybe 18 months. And I figured, oh, just get, you know, sit back and drink a beer, hang out. And it snapped back so fast that when we were defensively positioning in January and February, we sold all of our hospitals. We sold all of our continuing repair, our retirement community bonds, and we got really defensive going into March, and it worked out great. I figured I probably wouldn't need to do that for a long time, right? Well, here we sit, and I'm sitting here thinking I'm going to have to literally just redo the cycle again at some point, right? We're feeling like I'm seeing bonds trading that are at levels that makes absolutely no sense. So again, you know, that's kind of the opportunity. It's not just to the upside, but also protecting the downside too. So
yeah, you mentioned managing risk, right? Not just for opportunities, but hence the fund, you know, one of the funds, but also just in avoiding stepping back. And then I was like you, had taught the treasury market, you know, bond market early in my career doesn't lie. I don't know if it will this time, who knows, but the rates are hard to ignore. We have another colleague that always talks about, you know, when the rates get so low that the bond market starts to scream or is screaming, right? So we'll see what happens, right? I think time will tell.